You know, it's strange how confident people feel about money they haven't earned yet. They talk about future returns as if those returns are already guaranteed. They plan their lives around projections, averages, and assumptions, forgetting that money, unlike math on paper, lives in the real world, a world filled with fear, impatience, and human error. Benjamin Graham understood this better than most, not because he was reckless, not because he was bold, but because he was deeply suspicious of human behavior, especially his own. He didn't begin his thinking with markets. He began with people, and what he saw over decades of crashes, booms, and recoveries was simple. Most financial failure has very little to do with intelligence and everything to do with temperament. People don't lose money because they don't know enough. They lose money because they believe too much in themselves, in trends, in stories, and in the comforting idea that this time is different. Graham watched educated professionals destroy themselves financially while ordinary, disciplined individuals quietly built lasting wealth. The difference wasn't access to information. It was the ability to remain rational when emotions demanded action. That's where real investing begins, not with opportunity, but with restraint. Early in his career, Graham learned a lesson that would shape his entire philosophy. Markets don't exist to serve you. They exist to tempt you. They offer excitement, validation, and the illusion of control. But beneath all of that noise lies something far less glamorous and far more powerful: arithmetic. And arithmetic doesn't negotiate. If you pay too much, your intelligence won't save you. If you take risks you can't afford, optimism won't protect you. If you confuse speculation with investment, confidence will only accelerate the damage. Graham believed the first duty of an investor was not to make money, but to avoid losing it. That idea sounds conservative, even boring, until you realize how rare it is. Most people want returns before they want safety. Graham demanded safety before returns. He saw investing as a discipline of defense first and offense second. Because once you lose capital, you lose more than money. You lose time, clarity, and emotional stability. And without those, even the best opportunities become dangerous. One of Graham's most overlooked insights was this: the market is not a weighing machine in the short run. It's a voting machine. Prices move not because of value, but because of popularity. Fear and greed cast more votes than facts ever will. That's why most people feel intelligent during bubbles and foolish during crashes, even when they're behaving exactly the opposite. Graham warned against trusting your emotions during moments when they feel strongest. Confidence near market tops is seductive. Panic near bottoms is overwhelming. Both feel justified. Both are destructive. The intelligent investor, Graham argued, learns to distrust these feelings, not suppress them, but refuse to obey them. He often spoke of margin of safety, not as a technical concept, but as a psychological one. A margin of safety gives you room to be wrong. And being wrong, Graham believed, is not a failure. Refusing to prepare for it is. Most people structure their financial lives as if nothing unexpected will ever happen. Steady income, rising markets, stable health, continuous growth. Graham saw that as fantasy. History taught him otherwise. Recessions arrive unannounced. Jobs disappear without apology. Markets fall faster than they rise. The margin of safety is what allows you to survive these moments without being forced into terrible decisions. And forced decisions, in Graham's world, were the enemy of intelligent investing. He didn't believe investors failed because they lacked courage. He believed they failed because they lacked patience. They wanted results too soon, certainty too quickly, and validation immediately. Graham often said the investor's chief problem, and even his worst enemy, it is himself. That statement wasn't meant as an insult. It was a warning. Your instincts evolved for survival, not for capital allocation. Fear once kept humans alive. In markets, Fear makes them sell at the worst possible time. Excitement once rewarded curiosity. In markets, excitement convinces people they're smarter than probability. Graham understood that successful investing requires acting against your natural impulses, not once, but consistently. That's why he distrusted complexity, not because it was wrong, but because it invited overconfidence. He preferred simple rules that could survive stress, rules that worked when emotions were loud and clarity was scarce, rules that didn't require perfect judgment to succeed. One of those rules was refusing to confuse price with value. Price is what you pay. Value is what you receive. Most people never learn the difference. They assume rising prices confirm wisdom and falling prices signal danger. Graham taught the opposite. Falling prices often increase opportunity, while rising prices increase risk. But only for those prepared emotionally and financially. This is where Graham's thinking becomes uncomfortable for modern audiences. He didn't promise excitement. He didn't promise speed. He promised survival. He believed wealth was built not by brilliance, but by consistency, by doing reasonable things repeatedly over long periods while avoiding catastrophic mistakes. And catastrophe, Graham believed, often enters through leverage and debt. Borrowed money doesn't just magnify returns, it magnifies pressure. It reduces your margin of safety and replaces patience with urgency. When you owe money, time is no longer your ally. Every downturn becomes a threat. Every delay feels dangerous. Graham saw debt as a silent amplifier of human weakness. It forces people to act when the worst action is required. It turns temporary setbacks into permanent losses. That's why he emphasized financial independence long before it became fashionable. Independence wasn't about lifestyle. It was about decision-making. The investor who does not need to act has power. The investor who must act is vulnerable. Graham structured his philosophy around avoiding situations where action was required under stress. He wanted the freedom to wait, to think, to let markets come to him rather than chase them. Waiting, in Graham's world, was not inactivity. It was discipline. He believed inactivity was often the most intelligent choice, a radical idea in a culture that rewards constant movement. Most people equate action with progress. Graham equated restraint with intelligence. He watched investors trade themselves into exhaustion, fees, and regret, not because opportunities were rare, but because patience was. And patience, Graham argued, was not passive. It was trained. It required knowing your principles in advance, before emotion arrived. Because once fear or excitement takes over, logic becomes negotiable. That's why Graham insisted on rules. Not flexible guidelines, but firm boundaries. He didn't want investors asking, "What do I feel like doing today?" He wanted them asking, "What does discipline require of me now?" That distinction separated investors from speculators. Speculators, Graham observed, were not bad people. They were simply impatient. They wanted certainty without waiting, returns without discomfort, and rewards without boredom. Investors accepted boredom as the price of rationality. Graham didn't glamorize investing. He made it deliberately dull, because dull behavior, repeated long enough, produced extraordinary results. He understood something modern finance often forgets. Excitement is expensive. Every time you feel excited about an investment, ask who is selling it to you and why. Markets are efficient at one thing: transferring money from the impatient to the patient. Graham aligned himself with patience. He accepted that markets could remain irrational longer than anyone expected, that prices could fall further than logic suggested, that value could remain hidden longer than comfort allowed. But he also trusted that over time, reality asserts itself. Earnings matter, cash flows matter, balance sheets matter. Not today, not tomorrow, but eventually. And eventually is a word that terrifies impatient minds. Graham wasn't trying to beat the market every year. He was trying to survive every year. Outperformance, he believed, was a byproduct of survival, not its objective. This mindset shaped everything he taught. Protect the downside. Avoid permanent loss. Demand value. Leave room for error. Do these things consistently and time will handle the rest. Graham's students learned that intelligence alone was insufficient. Emotional control mattered more. Self-awareness mattered more. Knowing what not to do mattered more than knowing what to do. He believed most investors would improve dramatically if they simply did less. Less trading, less forecasting, less reacting, more thinking, more waiting, more discipline. That philosophy feels uncomfortable in a world addicted to speed. But discomfort, Graham knew, was often a signal you were doing something right. He believed the market's greatest reward was reserved for those willing to look wrong for long periods in exchange for being right eventually. That requires humility in something markets aggressively punish in the short term, but quietly reward in the long term. Graham didn't promise wealth to everyone. He promised survival to those willing to think clearly, and survival, compounded over decades, quietly becomes wealth. In the end, Graham's philosophy wasn't really about stocks. It was about behavior, about respecting uncertainty, about refusing to let emotion dictate decisions, about building a financial life that could withstand reality instead of denying it. He taught that true wealth isn't built by predicting the future, but by preparing for it, and preparation, unlike prediction, is always within your control. That is why Benjamin Graham still matters. Not because markets have changed, but because human nature hasn't. The same fear, the same greed, the same impatience, and the same opportunity for those disciplined enough to ignore the noise. Respect the math and let time work quietly in their favor. That's not fast money. That's not exciting. But it works. And in the end, that's all that ever mattered.